Hello, and thank you for joining us on the Money Goose podcast. In this episode, we will be talking about the basics of investing and how to get started on your financial journey. Um, so let's kick things off with maybe the most basic but crucial question. Why should someone bother investing at all? Why can't we just keep our money in a savings account and call it a day?
Honestly, that's a pretty common instinct, but the reality is inflation quietly eats away at the value of your savings over time. Even if you feel safe just parking cash, after a decade your money could buy a lot less, sometimes 25% less buying power than today. Investing helps your money grow faster than that invisible erosion.
So it's basically about fighting the slow leak from inflation. But what kind of growth are we really talking about when people invest?
Historically, stocks have averaged around 10% a year before inflation, or about 7% after adjusting for it. Bonds are usually lower, maybe 2 to 4% above inflation. It's the magic of compounding. Small, steady investments can snowball into serious wealth over decades.
Now, before we get lost in the weeds, I want to clarify what counts as investing. Is it just buying stocks, or are there other ways to invest too?
Great point. It's way more than just stocks. You can invest by owning pieces of companies, stocks, lending money, bonds, or pooling money with others in things like mutual funds or ETFs. Real estate, commodities, even things like REITs and annuities enter the mix too.
So, if I buy one S&P 500 ETF, I'm investing in hundreds of companies at once, right?
Exactly, and that helps spread out your risk. Buying one company's stock is direct ownership, but it's riskier. If that company tanks, your investment could go with it. Diversified funds give you broader exposure with a single trade.
That brings up the whole risk and reward thing. Can you talk about how people should think about risk, especially when they're new to all this?
Absolutely, every investment comes with a trade-off. Higher potential reward almost always means higher volatility or risk. For example, putting everything into a booming tech stock could yield a windfall or a wipeout. Diversifying, like a 6040 stock bond split, smooths out the bumps.
Is that why so many people talk about not putting all your eggs in one basket?
That's the heart of it. Spreading out across stocks, bonds, cash, maybe even real estate protects you from one disaster, dragging down your whole portfolio.
So, let's say someone is ready to dive in. How much do they really need to know about things like fees, taxes, or even compounding before they start?
Honestly, a little know-how goes a long way. For example, choosing a fund with a 1.5% fee over one with a 0.2% fee can cost you tens of thousands over decades. Understanding tax-advantaged accounts like 401ks or IRAs can also mean a much bigger retirement fund. These details really add up.
So, keeping an eye on those small percentages is more important than a lot of people realize.
Exactly. Even a 1% difference in fees or returns, compounded year after year, can change your outcome in a huge way.
All right, shifting gears for a sec, let's talk about plain old banking accounts. What's the real difference between a savings and a checking account in the context of investing?
Think of checking accounts for everyday spending, groceries, bills, whatever, and savings accounts as your emergency cushion. Savings typically pay a little more interest, and both are FDIC insured up to $250,000. But neither is designed for long-term growth.
So, keeping 3 to 6 months of expenses in a high yield savings account is smart, but after that, it's time to look elsewhere?
Exactly. Anything beyond that emergency buffer is usually better off working for you in investments with a higher growth potential.
Okay, once you've got your emergency fund, people keep mentioning brokerage accounts. What are they really, and how do they work?
A brokerage account is basically your gateway to the investing world. You can buy stocks, ETFs, mutual funds, and bonds all in one place, and you're not limited by how much you can deposit. The main catch is taxes. If you sell for a profit, you owe capital gains tax.
So, if I hold a stock for a year or more, do I get better tax treatment?
Yep, long-term gains get taxed at lower rates than short-term gains, which are treated as ordinary income. It pays to plan your holding periods.
You mentioned those special accounts like 401ks, IRAs, and 529 seconds. Can you unpack how they're different from a basic brokerage account?
Sure, Retirement accounts like 401ks and IRAs let your money grow tax deferred or sometimes tax free, but they have limits on how much you can contribute each year. A 529 is for education, grows tax free if used for school expenses, and can come with state tax perks too.
So, for most people, is it smart to max out those tax advantage accounts first?
Absolutely. Using those accounts can seriously boost your net returns over time, especially when you factor in employer matches or tax savings.
All right, let's dig into the stock market itself. It can seem like this mysterious beast. What is actually happening when someone says they're in the market?
Picture the stock market as a giant auction house. People are constantly buying and selling pieces of companies, and the prices move based on what buyers are willing to pay and sellers want right now. Major exchanges like NYSE or NASDAQ host thousands of these companies.
So, when I buy a stock, I'm not buying from the company directly, but from another investor.
Exactly. Once a company has sold its shares in an IPO, those shares just change hands in the secondary market. You're trading with other investors, not the company itself.
That actually reminds me, when you hit buy in your app or website, what happens next? How does your order become an actual trade?
Your order enters a big digital order book, matching buyers and sellers. There's market orders, which fill instantly at the best price, and limit orders, where you set the price you want. In highly traded stocks, your order is filled quickly and at prices close to what you see, but in thinly traded ones, it's not always that smooth.
So sometimes you might buy a stock for more than you expected if the market moves fast or there's not much trading.
Exactly, that's called slippage. It's usually minor in big companies, but worth watching out for in more obscure stocks.
All this trading talk always brings out a ton of jargon, PE ratios, market cap, basis points. Which terms should new investors actually pay attention to?
Start with the basics. Shares mean a slice of ownership, market cap tells you how big the company is, and dividends are cash payouts. PE ratio helps you compare similar companies, while yield tells you how much income you get for each dollar invested. And don't ignore expense ratios, they directly impact your long-term returns.
So even tiny differences in expense ratios can make a huge difference after a couple decades.
They sure can. A fund charging 0.03% versus 0.5% leaves you with way more money after 20 or 30 years.
Let's talk about the actual vehicles you can invest in: stocks, bonds, funds, real estate, and so on. How should someone decide what mix is right for them?
It all comes down to your goals, risk tolerance, and time horizon. Younger folks might go heavier on stocks for growth, while someone nearing retirement will want more bonds and maybe some real estate for stability. Funds, like ETFs and mutual funds, are great for instant diversification, spreading your bets across many assets in one shot.
And for someone just starting out, is it safer to stick with broad index funds than hand-picked stocks?
Definitely. Index funds and ETFs are easy, low fee, and reduce the risk you'll pick a dud. They make sticking to a plan much simpler for most beginners.
So now let's get real. How does someone know how much risk is right for them, or how to actually build a portfolio?
Honestly, your age, financial stability, and even your gut feelings about seeing your account drop all matter. If you're young and have decades before retirement, you can usually stomach more ups and downs for higher growth. If you're close to needing the money, playing it safer with more bonds makes sense.
And having an emergency fund lets you ride out market storms without panicking, right?
Exactly. If you've got stable income and savings, you won't be forced to sell at the worst possible moment. That peace of mind makes sticking to your plan a lot easier.
Funny you say plan, everyone keeps saying diversify. What does that look like in practice? And how do you actually do it?
Think of it as not betting on just one horse. Mix your investments across different asset classes: stocks, bonds, real estate, even a bit of commodities. Use funds or ETFs for instant, broad exposure. Don't forget to spread across sectors and maybe include some international stocks too.
So it's not just about owning a bunch of different stocks, but truly mixing different types of assets.
Exactly. That way, if one part of your portfolio takes a hit, others can help cushion the blow. And rebalancing, adjusting your mix every year keeps your risk steady over time.
Let's get practical for a second. What should a total beginner do first versus someone with more experience or specific goals like early retirement?
For beginners, build your emergency fund, open a low-fee brokerage or 401k, and start with broad index funds. Automate small, regular contributions. If you're more experienced, you might add international or small cap funds, use tax strategies, or tilt allocations based on your plan. And for early retirees, keeping a bigger cash cushion and a flexible withdrawal plan is crucial.
And for those nearing retirement, it's more about income and safety, right?
You got it. Shift toward bonds, ladder maturities, maybe explore annuities, and plan out withdrawals so a market drop doesn't throw everything off track.
All right, last big topic to bring it all together. What about when it's actually time to take money out? What should people be thinking about when they're ready to spend from their investments?
Here's where planning pays off big time. Model your withdrawals using rules like the 4% rule, but know that market swings can throw things for a loop. Combining a mix of stocks and bonds, keeping a cash buffer, and pulling from the right accounts in the right order can help your money last.
So the focus is on flexible withdrawals, tax smart strategies, and still keeping costs down.
Exactly. Regular rebalancing, low-cost index funds, and a plan for sequence risk where bad returns early in retirement can hurt most. Keep your retirement on track.